Welcome back to We Here Now. I'm X. Let's get to it. So, we are in the trading doctrine. Right now, we are at 1.3 frames explained. Why higher time frames control the market. All right, let's get into it. So, like always, I'm always going to have, something up here for the time being. Uh, Yeah, so I'll just show you what this is right here. What I am projecting is a inverse head and shoulders. I know you guys don't know what that is, but typically this is the head, boom. This is the head, and then shoulder, shoulder. I can always turn it around for you guys, and this is what it looked like: head, shoulder, shoulder. All right, let's flip that back. All right, so If you if you've ever looked at a chart and felt like price was completely random, there's a good chance you were looking at the wrong time frame. One of the biggest mistakes beginners make is focusing on extremely small time frames while ignoring the bigger picture. But in reality, markets operate in layers. Large time frames control direction, small time frames simply react. Understanding this hierarchy is one of the most important concepts in professional trading. In the previous lesson, we talked about how candlesticks chart works. Each candle represents a period of time and shows us the open, the high, the low, and the close during that period. But something interesting happens when you change the time frame. The exact same market can look completely different depending on how much time each candle represents. And this is where many beginners become confused. And I promise you guys, it is not confusing. It is not confusing. So, time frames simply define how much time each candle represents. Excuse me. For example, a daily chart shows one candle for every trading day. A 12-hour chart shows one candle for every 12 hours. A weekly chart shows one candle for an entire week of market activity. Think of time frames like zoom levels on a camera. Lower time frames zoom in and show more detail. Higher time frames zoom out and show the bigger structure of the market, which is king. Here's where things become important. Higher time frames represent more market activity and more capital. A single 5-minute candle might represent a small group of traders, but a weekly candle represents an entire week of transactions involving large institutions and funds. Because of this, higher time frames tend to carry more weight. They show the true direction of structure of the market. Lower time frames mostly react to the larger participants to what they are doing. So here's an example of time frame conflict. Imagine looking at a small time frame chart that shows price moving sharply upward. It might look like a strong uptrend, but when you zoom out to a higher time frame, you might discover something completely different. That move could actually be a small bounce inside a larger downtrend. This is why professional traders almost always analyze markets starting from larger time frames first. In other words, top down analysis. All right, now we're going into time frame Hierarchy. Professional traders think of markets in layers. The higher time frame defines the environment. The lower time frame helps refine execution. So instead of asking, what is the market doing right now? A professional trader asks, what is the larger trend? And how can I align with it? This approach dramatically improves consistency. If this, then that logic. So here's some simple decision logic. If higher and lower time frames agree, the market environment is clearer. If lower time frames move against higher time frames, the move may only be temporary. If the higher time frame is unclear or sideways or ranging, that's what sideways means, trading conditions may be more difficult. Understanding this relationship helps traders avoid chasing small term noise. A common beginner mistake. One of the most common mistakes beginners make is starting their analysis on extremely small charts, and I was one of them. These charts contain a lot of short term noise and can make markets appear random. Professionals usually start with the higher time frames first to understand the broader structure. Then they move down to a smaller time frame to refine entries. So, it's basically it for this video. But I'll continue doing what I'm doing. It's been a long day at work. Guys, please bear with me. So, in the next lesson, we're going to start applying these ideas to something extremely important in trading: risk. I cannot stress that enough. Risk is one of the most important things you guys have to learn. Because even if you understand charts and time frames, none of it matters if you don't control how much you lose when you're wrong. Professional traders don't survive because they predict markets perfectly. They survive because they manage risk consistently. And this is exactly what we will cover next. So guys, if you stay here to the end, I appreciate you guys, and I'm hoping that you guys are getting some good knowledge from what I spent time on trying to get to you guys. So without further ado, I'll see you guys on the next video, and looking forward to making some money together. All right, I'm X. You've been watching We Here Now. I'll see you guys on the next one. Peace.